Something unusual is happening in the silver market, and if history is any guide, Warren Buffett might be at the center of it. Right now, silver is sitting at a critical inflection point. Vaults are draining at unprecedented rates. China just banned silver exports. Industrial demand is exploding from solar, electric vehicles, and AI data centers. And the world is facing its 5th consecutive year of structural deficit, meaning we are consuming far more silver than we are producing. But here's what makes this truly interesting. The last time these exact conditions appeared, Warren Buffett made one of the most aggressive commodity plays of his career. He secretly accumulated 129.7 million ounces of physical silver, 20% of the world's available supply, and held it for nearly a decade. That was 1997, and the parallels between then and now are absolutely striking. Buffett is now sitting on $381.7 billion in cash, an all-time record for Berkshire Hathaway. He's been a net seller of stocks for 12 consecutive quarters, dumping massive positions in Apple, Bank of America, and Kraft. He's clearly positioning for something big. And on February 14th, 2026, we're going to get a major clue. That's when Buffett's 13F filing comes out, the mandatory disclosure that reveals exactly what he bought in the fourth quarter of 2025. If silver shows up on that list, the market could go absolutely wild. But even if it doesn't appear publicly, there's a strong case that Buffett is already quietly accumulating physical silver again, just like he did in 1997. And in this video, I'm going to show you why the conditions today are not just similar to 1997. They're actually far more explosive. Let's break it down. Let's go back to 1997 and understand what Buffett did, and more importantly, why he did it. Starting on July 25th, 1997, Buffett began quietly buying silver. He used a broker called Fibro to avoid tipping off the market. And over the course of several months, he accumulated an absolutely massive position. 129.7 million ounces of physical silver. Not paper contracts, not futures, not ETFs, physical metal delivered to vaults in London under the London Bullion Market Association. To put that in perspective, Buffett's purchase represented 20% of the entire global annual production of silver at that time. It was also roughly 20% of all available inventories worldwide. This wasn't a speculative bet. This was a calculated move to corner a significant portion of the global physical supply. His entry price was around $4.50 per ounce, and he kept the position secret until early 1998, when Berkshire Hathaway was legally required to disclose it in a public filing. The moment the disclosure hit, the silver price exploded. Within weeks, silver jumped from around $6 to over $7 per ounce, a move of more than 15%. Buffett held that position for roughly 10 years, and if he had held it until today, that silver would be worth over $13 billion. But here's the key question. Why did Buffett make that move in the first place? The answer is simple. He saw a structural supply deficit. In 1997, the world was consuming about 150 million more ounces of silver per year than it was producing. Inventories were shrinking, vaults were draining. And Buffett recognized that when physical supply gets tight, price has nowhere to go but up. He wasn't betting on short-term price swings. He was betting on the fundamental reality that you can't consume more of something than you produce indefinitely. Eventually, the shortage forces a price reset. And that's exactly what's happening today, except the numbers are far bigger, the deficit is far worse, and the industrial demand is far more structural. Let's compare the deficit Buffett saw in 1997 to what we're seeing today. In 1997, the annual silver deficit was approximately 150 million ounces. That means the world was consuming 150 million more ounces than it was mining and recycling. Over the course of the previous 5 years, that cumulative deficit had reached roughly 700 million ounces. That was enough to get Buffett's attention. That was enough for him to deploy billions of dollars into a physical commodity, something he almost never does. Now let's look at today. From 2021 through 2025, the cumulative silver deficit has reached 820 million ounces. That is more than the entire cumulative deficit leading up to Buffett's 1997 purchase, and it happened in just 5 years instead of a full decade. We're now in our 5th to 6th consecutive year of structural deficit. And unlike 1997, this deficit isn't driven by temporary demand spikes or one-off events. It's driven by long-term, irreversible industrial trends. Annual mine supply of silver is roughly 800 million ounces. Recycling adds another 150 million ounces. So total supply is around 950 million ounces. But annual consumption? Over 1 billion ounces, and rising. That gap, that 50 to 100 million ounce annual deficit, is eating away at global inventories every single year. And there's no easy way to close it. Why? Because 70% of silver production is a byproduct of mining other metals like copper, lead, and zinc. You can't just turn up silver production the way you can with oil or wheat. If copper demand is weak, silver supply stays flat, even if silver prices are rising. This supply and flexibility is critical. It means that even as demand surges from solar, EVs, and AI, supply can't keep up, and that imbalance is accelerating. Let's put that 820 million ounce cumulative deficit into perspective. 820 million ounces is more than an entire year's worth of global mine production. It's also more than 5 times the total amount of silver Buffett bought in 1997. Where did all that silver go? It got consumed, used up, turned into solar panels, circuit boards, batteries, medical devices, and AI server components. Much of it will never be recycled. And here's the scary part. The deficit is accelerating. In 2021, the deficit was manageable, maybe 50 million ounces. By 2023, it had grown to over 100 million ounces annually. And in 2025, some analysts estimate the deficit hit 150 million ounces or more. This isn't a blip. This is a structural shift in how the world uses silver. And it's only going to get worse, or from an investor's perspective, better. Because when you run a deficit this large for this long, something has to give. Either prices rise dramatically to incentivize new production and reduce demand, or the supply chain breaks entirely, and you get shortages, delivery failures, and market dysfunction. We're already seeing early signs of both. Physical premiums, the markup over spot price that dealers charge for coins and bars, are spiking. Delivery times are stretching out, and most importantly, the vaults are draining. Back in 1997, the biggest industrial use for silver was photography. Film cameras, darkroom chemicals, medical imaging, all of it required silver halide compounds. But here's the thing, photography is dead. Digital cameras killed film, and that massive source of silver demand evaporated almost entirely within a decade. You'd think that would have caused a collapse in silver demand, right? It should have freed up hundreds of millions of ounces annually, but the exact opposite happened. Because just as photography died, 3 new megatrends emerged: solar energy, electric vehicles, and artificial intelligence. Let's start with solar. In 2023 alone, solar panel production consumed 197 million ounces of silver. That's nearly 25% of total global supply going into just one sector. And that number is projected to hit 270 million ounces or more by 2030. Why? Because every solar panel requires silver paste for its conductive pathways. There's no viable substitute that matches silver's efficiency and cost at scale. China alone is installing 160 gigawatts of new solar capacity per year. Each gigawatt requires roughly 1.5 million ounces of silver. Do the math? That's 240 million ounces just for Chinese solar installations. Next, electric vehicles. A traditional gasoline-powered car uses about 15 to 20 grams of silver. An electric vehicle uses up to 50 grams, more than double. And as EV production ramps up globally, millions of units per year, that silver demand is compounding. China is producing over 10 million EVs per year. If each one uses 50 grams of silver, that's 500,000 kilograms, or roughly 16 million ounces annually just from Chinese EV production. Finally, artificial intelligence and data centers. AI servers require massive amounts of silver for circuit boards, connectors, thermal management, and high-frequency trading infrastructure. As AI deployment accelerates, this demand stream is just beginning to show up in the numbers, but it's already measurable and growing fast. So you've got 3 demand sources: solar, EVs, and AI, that didn't exist in any meaningful way in 1997. And all 3 are structural, long-term, and irreversible. This isn't a demand spike. This is a permanent step change in how much silver the global economy needs to function. Now let's talk about the clearest signal that something is seriously wrong in the silver market: the vault drain. In 1997, Buffett paid close attention to global vault inventories. He noticed they were shrinking. He noticed that physical silver was becoming harder to source, and that's what gave him the confidence to make his massive bet. Today, the vault drain is far more dramatic. Since 2021, the London Bullion Market Association vaults, the primary storage facility for physical silver in the West, have lost over 400 million ounces. That's nearly half of global annual production, simply vanishing from the vaults over a 4-year period. Where did it go? Into industrial use, into private hands, into places where it's not coming back. And it's not just London. The Shanghai Futures Exchange, which tracks Chinese silver inventories, has seen a catastrophic collapse. As of early 2026, Shanghai vaults hold just 450 tons, or roughly 13.5 million ounces. To put that in perspective, 13.5 million ounces is less than 2 weeks' worth of global industrial demand. It's a rounding error, and yet Shanghai is supposed to be one of the 2 major physical silver hubs in the world. If their inventories are this low, it means the physical market is running on fumes. This is the exact same pattern Buffett saw in 1997, except the drain is happening faster, deeper, and across multiple vault systems simultaneously. When inventories fall this low, it doesn't matter what the paper price says. Physical silver becomes scarce, premiums explode, and the people who own the metal have all the leverage. And now we come to the bombshell move that changes everything: China's silver export ban. On January 1st, 2026, China officially classified silver as a strategic mineral and imposed strict export controls. Under the new regulations, only a limited number of licensed companies, reportedly just 44 firms, are allowed to export refined silver out of China. This is a game changer, because China doesn't just produce a lot of silver, they control the refining infrastructure. Roughly 60 to 70% of the world's refined silver passes through Chinese refineries. Even if silver is mined in Mexico, Peru, or Australia, it often gets shipped to China for refining before being re-exported to the West. But now that flow is being choked off. China is saying, we need this silver for our own solar panels, our own EVs, our own electronics manufacturing. The West can't have it anymore. And there's almost nothing the West can do about it. You can't just build new refining capacity overnight. It takes years and billions of dollars in capital investment. So what happens? Western silver supply collapses. Premiums spike. And the already tight physical market becomes even tighter. This is economic warfare disguised as industrial policy. And it puts enormous pressure on Western manufacturers, investors, and exchanges like COMEX that rely on the flow of physical metal to back their paper contracts. Let's dig deeper into why China's export ban is so devastating. China controls somewhere between 60 and 70% of global silver refining capacity. That means even if you mine silver in South America, you're probably shipping the raw concentrate to China to be turned into refined bars and granules, because China built out massive low-cost refining infrastructure over the past 2 decades. They have the technology, the labor, and the economies of scale that make Chinese refining cheaper and more efficient than almost anywhere else. Western countries let this happen because it was economically convenient. Why spend billions building your own refineries when you can just outsource to China? Why? But now that dependence has become a strategic vulnerability, because China can and is using their refining dominance as a geopolitical lever. By restricting exports, China ensures that all the silver flowing through their system stays in Asia. They can allocate it to their own industries first. They can sell it to allies at preferential rates, and they can leave the West scrambling for scraps. This is exactly the playbook they've used with rare earth elements, and now they're doing it with silver. For investors, this creates a critical divergence. The price you see on COMEX or the LBMA may not reflect the true scarcity of physical silver. Because if you can't actually get the metal delivered to where you need it, the paper price becomes meaningless, and that's when premiums explode. That's when the physical market decouples from the futures market, and that's when the people holding real metal in their vaults, people like Warren Buffett, win big. Now let us zoom out and look at the macro environment, because the parallels between 1997 and 2026 are downright eerie. In 1997, the world was dealing with the Asian financial crisis. Currencies were collapsing across Thailand, Indonesia, South Korea, and Malaysia. The Japanese yen was under severe stress. The Russian ruble was teetering on the edge of default. Central banks were panicking. Faith in fiat currency was shaken. And smart investors like Buffett were looking for hard assets that couldn't be printed or devalued. Fast forward to 2026, and we're seeing almost identical dynamics. The Japanese carry trade, where investors borrow yen at near zero interest rates to invest in higher yielding assets, is starting to blow up. Japanese bond yields are rising sharply, forcing massive unwinds of leveraged positions. The US dollar just had its worst year since 2017, dropping 9% in 2025. That's a massive devaluation for the world's reserve currency. And here's the kicker. For the first time since 1996, central banks now hold more gold than US Treasury bonds. That's a seismic shift. It means central banks are losing faith in US debt and moving toward hard assets. This is the same backdrop that drove Buffett into silver in 1997. Currency instability, central bank distrust, a flight to real assets. And Buffett has always hated inflation and currency debasement. He's said repeatedly that the best protection against a weakening dollar is to own productive assets or scarce commodities. Silver fits that description perfectly, and the macro chaos we're seeing today makes it even more attractive than it was in 1997. Now let's talk about Buffett's war chest. As of the end of 2025, Berkshire Hathaway is sitting on $381.7 billion in cash and cash equivalents. That's an all-time record, not just for Berkshire, but for any corporation in history. Why is Buffett hoarding so much cash? Because he's waiting for the right opportunity. He's waiting for assets to get cheap. He's waiting for a moment when he can deploy massive capital into something undervalued and scarce. And here's the thing. The entire global annual production of silver is worth roughly $25 billion at current prices. That means Buffett could buy every single ounce of silver mined on Earth this year, and it would only cost him 6% of his cash pile. Or, to replicate his 1997 purchase of 130 million ounces, he'd need roughly $10 to $12 billion at today's prices. That's pocket change for Berkshire. And unlike stocks, bonds, or real estate, physical silver can be accumulated quietly. There's no public filing requirement until after the fact. Buffett could be buying right now, and we wouldn't know until February 14th, when the 13F filing drops. That cash pile isn't sitting there by accident. Buffett is preparing for something. And given the supply deficit, the vault drain, the export ban, and the macro chaos, silver is one of the most logical plays he could make. Here's another critical clue. Buffett has been a net seller of stocks for 12 consecutive quarters. He's dumped massive positions in Apple, once his largest holding. He's sold billions of dollars worth of Bank of America shares. He's exited Kraft Heinz and other consumer staples. When Buffett sells aggressively like this, it's not because he thinks those companies are bad. It's because he thinks they're fully valued, or worse, overvalued, and he wants to raise cash for something better. Buffett doesn't sell just to sit on cash forever. He sells to redeploy into asymmetric opportunities. And right now, the stock market is near all-time highs. Valuations are stretched, and most assets are expensive. But commodities, especially silver, are historically cheap relative to financial assets. The gold to silver ratio is still elevated. Silver hasn't had a major bull run in over a decade, and the fundamentals are screaming shortage. If Buffett is selling stocks and hoarding cash, he's preparing to buy something big. And silver checks every box: undervalued, scarce, structural deficit, industrial demand explosion, and geopolitical supply shock. So when do we find out if Buffett actually bought silver? February 14th, 2026. That's when all institutional investors with over $100 million in assets under management must file their 13F disclosures with the SEC. This filing reveals every stock, ETF, and certain other securities that Berkshire Hathaway bought or sold in the fourth quarter of 2025. Now, here's the catch. Physical commodities like silver bullion don't always show up on 13F filings. If Buffett bought actual bars of silver and stored them in vaults, we might not see it. But if he bought shares of the SLV Silver ETF, or if he took positions in silver mining companies, those would show up. So February 14th is the first major checkpoint. If we see large positions in silver-related assets, the market will know, and the price could explode overnight, just like it did in 1998 when Buffett's position was disclosed. But even if nothing shows up publicly, that doesn't mean Buffett isn't accumulating. It just means he's doing it quietly, through private brokers, offshore vaults, or shell companies that don't trigger disclosure requirements. Either way, the pieces are all in place for a massive move. So what's the single most important signal that Buffett follows? It's this: physical shortage. Buffett doesn't buy commodities based on price charts or technical analysis. He buys them when the fundamentals scream scarcity. In 1997, he saw vault inventories shrinking. He saw a cumulative deficit building. He saw industrial demand outpacing supply, and he acted. Today, all those signals are flashing red, and they're far more extreme than they were in 1997. The vault drain is deeper, the deficit is larger, the industrial demand is more structural, and the geopolitical supply shock from China's export ban is unprecedented. Buffett has always said his favorite holding period is forever. He doesn't trade. He buys assets that are fundamentally undervalued, takes physical delivery when possible, and waits for the market to recognize reality. Silver today fits that playbook perfectly. Here's the bottom line. Warren Buffett taught the world a critical lesson in 1997. When you have a structural physical shortage, price will eventually reflect reality. It doesn't matter how much paper gets traded. It doesn't matter how many futures contracts get rolled over. At some point, the physical market asserts itself. And when it does, the people holding real metal win. Today, the shortage is worse, the demand is higher, the supply is tighter, and China just weaponized the refining infrastructure. Whether or not Buffett is buying silver again, the setup is undeniable. And February 14th will give us the first big clue. So watch that filing. Watch the vault inventories, and watch the premiums on physical silver. Because history doesn't repeat, but it sure does rhyme. Let me know in the comments. Do you think Buffett is loading silver again? And if he is, what do you think the price does when it's disclosed? I'll see you in the next one.